Warren Buffett, the man they call the Oracle of Omaha, just hit his 95th birthday and is getting ready to pass the torch as CEO of Berkshire Hathaway. So, what's the secret sauce behind his absolutely legendary success? Well, today, we're going to unpack his entire investment philosophy, a blueprint that holds some serious lessons for any investor out there.
First, let's just start with the number that says it all. 5.5 million%. That is the actual real return of Berkshire Hathaway stock from 1965 to 2024. It's a number so huge it almost feels fake, but it is the bedrock of his entire legacy.
So what does a number like that even mean in the real world? Well, get this. If you had invested just $100 in Berkshire Hathaway way back in 1965, today, it would be worth $5.5 million. Now, that same $100 in a normal S&P 500 fund, you'd have about $39,000. That's great, but it's not even in the same universe. This isn't luck, folks. This is a strategy.
So how on earth did he build that $5.5 million return from just $100? You know, the story doesn't start in some fancy Wall Street office. It starts with a kid from Omaha.
Buffett's journey kicked off all the way back in 1942. He was just 11 years old when he bought his first stock, and right away he learned a tough lesson about selling too soon. Fast forward to 1956, and he's running an investment fund literally from his bedroom. Then came the big one. In 1965, he took over a failing textile company called Berkshire Hathaway and started molding it into the $1 trillion behemoth it is today.
All right, so here's the first big secret. It all starts with the right mindset. Buffett's real genius isn't just about picking hot stocks. It's about how he thinks about them. See, he doesn't see stocks as just flashy symbols on a screen. He sees them as what they are, tiny pieces of ownership in a real business.
And the most important part of that mindset is this idea of an economic moat. Just think of a castle. What protects it from invaders? The moat around it. For a company, this moat is some kind of lasting competitive advantage that protects its profits from all the other companies trying to take a piece of the pie.
And these moats, they come in all shapes and sizes. It could be the unstoppable brand power of a company like Coca-Cola, right? Or the sheer market dominance of American Express. These aren't just little advantages. They're deep, structural strengths that make a business tough as nails.
You can really boil this whole mindset down to a pretty simple checklist. First, stay in your circle of competence. Only invest in businesses you actually understand. Second, look for strong, honest management. You got to trust the people running the show. Third, focus on the value per share, not just how big a company gets. And finally, never stop learning. That's a lesson Buffett himself took to heart from his mentor's book, The Intelligent Investor.
Okay, so understanding how to think like Buffett is step one. But the next, and maybe harder part, is learning how to act like him. This part of the playbook is all about discipline, psychology, and probably most of all, patience.
This quote just says it all, doesn't it? In investing, you don't get called out on strikes. You don't have to swing at every single opportunity. You can just wait and wait for that perfect pitch, the one that's right in your sweet spot. And then you swing for the fences.
And if you want to see what that patience looks like in real life, just look at this. In the first quarter of 2025, Berkshire Hathaway was sitting on a cash pile of $333 billion. That is more than the entire value of massive companies like Netflix or Disney. That's not just lazy money, it's what he calls dry powder, ready to go when a truly amazing opportunity comes along. This right here is the psychological key to the whole strategy. It's about going against the crowd. When the market is freaking out and everyone's selling, that's usually the best time to be buying. And when everyone's giddy and prices are through the roof, that's when you need to be a little skeptical.
And he has put his money where his mouth is, time and time again. During the 2008 financial crisis, he swooped in to invest in giants like Goldman Sachs and GE. And just recently, the Wall Street Journal reported on May 9, 2025, that during a market dip in April, Berkshire bought a $1.6 billion stake in United Health. And guess what happened after the news came out? The stock popped 12%.
Now, this might surprise you. Most advisors tell you to diversify, right? Spread your money out. Buffett does the opposite. He believes in concentration. When he finds a truly great business, he bets big. I mean, look at this. Just 5 stocks make up around 70% of Berkshire's entire public stock portfolio. Now that is conviction.
Of course, the billion-dollar question, or maybe trillion-dollar question, on everyone's mind is, what happens to Berkshire after the legend himself steps down? Well, the answer is all in the succession plan.
Meet Greg Abel. He's the designated successor. Now, he's not the charismatic oracle we see on TV. He's known as a more quiet, heads-down operator who's a master at making deals. But here's the crucial part. Buffett himself has called him a big improvement and has made it clear their thinking is perfectly aligned.
So the key thing to take away here is continuity. Abel is a true believer in that core value investing philosophy. Berkshire's many businesses will continue to run independently. And hey, Buffett isn't vanishing. He's staying on as chairman to help with the big money decisions. You can bet a lot of people will be watching those Q4 2025 earnings reports to see how things look.
So, we've gone through the mindset, the playbook, and what the future holds. The last question is, how can an everyday investor like you turn all these lessons into your own personal roadmap?
You could actually translate this whole philosophy into 5 really practical first steps. 1. Look for value. A good starting point is screening for companies with a price-to-earnings ratio under 15. 2. Use free tools. The SEC's EDGAR database has a ton of info. 3. Read the annual letters from great CEOs. You'll learn a ton about how they think. 4. Build that cash reserve. Try to keep 10 to 20% of your portfolio ready to pounce on an opportunity. And 5. The big one. Start as early as you can. The power of compounding is like magic over time.
And this quote from Jason Zweig of the Wall Street Journal just wraps it all up perfectly. Buffett's success isn't some kind of magic trick. It's a clear roadmap. It's not easy, no, because it takes discipline, but it is a path that any educated amateur investor can actually follow.
So that leaves us with just one final question, and this one's for you. After seeing the mindset, the playbook, and the practical steps, what's your first move going to be? Because that journey to a multi-million-dollar return, it always starts with a single step.